Welcome to The Explainer. Have you ever really thought about how a company knows the exact moment to count a sale? Say you buy a new phone. Do they book that revenue when you click buy, when it leaves the warehouse, or when it actually lands in your hands? Well, today we're going to pull back the curtain on IFRS 15, the global rulebook that answers that exact question. So here's what we're going to cover. First, we'll look at why we even needed this new rule in the first place. Then we'll get to the single big idea that drives everything. After that, we'll walk step by step through the 5-step model that every company uses. And finally, we'll look at some common tricky situations to see how it all plays out in the real world. Sound good? Let's get to it. Okay, first things first, let's talk about the why. Why did the accounting world decide to create this whole new standard? What was so broken about the old way of doing things? Well, before 2018, things were a bit of a mess. Honestly, it was a total patchwork. You had one set of rules for construction companies, another for software, and yet another for telcos. It made comparing companies in different industries a real headache. You were basically comparing apples to oranges. And just look at all the old rules it replaced. We had separate standards for construction, customer loyalty programs, real estate deals, you name it. IFRS 15 came along and basically swept all of this off the table. It created one single comprehensive framework for pretty much every contract with a customer. So much cleaner, right? So, if we threw out all those old, complicated rules, what's the one big idea that took their place? Well, it all boils down to one simple, yet really powerful word: control. And here it is, straight from the source. The whole point is to recognize revenue in a way that shows the transfer of goods or services. See, it's not about when the cash changes hands. It's about when the customer actually gets what they paid for. This was a huge shift in thinking, away from what the seller is doing and towards the customer's experience. And this is what control really means. It means the customer is now in the driver's seat. Think about buying a car. The second you get those keys, you have control. You can drive it, you can sell it, you can crash it. It's yours. That is the moment the car dealership can recognize the revenue from that sale. It's all about that transfer of control. Okay, so the big idea is control. But how do companies apply that idea consistently to every single sale? Well, IFRS 15 gives us this really clear 5-step model to follow. This is the practical engine of the whole standard. And here it is. This 5-step process is basically our roadmap for the rest of this explainer. It's a really logical flow, from figuring out if you even have a deal, all the way to finally putting that revenue on the books. So let's break these down, one by one. All right, let's dive into the model, starting with the first 2 foundational steps. We have to identify the contract, and then we have to figure out exactly what promises we made inside that contract. Now, step 1 seems pretty basic, right? Of course there's a contract, but this is actually a super important check. You need to make sure you have a real, legit agreement. Both sides have to be committed, you have to know what's being sold and for how much, and this is a big one, you have to be pretty sure you're actually going to get paid. If you don't tick all these boxes, you can't go any further. Okay, so you've got a contract. Step 2 is to break it down and find your performance obligations. That's the fancy accounting term for the promises you've made to the customer. Think of it like this. If the contract is the grocery bag, the performance obligations are the individual items inside it. Now, the tricky part is figuring out if each promise is a separate item or if it's all just one big bundle. We call this being distinct, and there's a 2-part test. First, could the customer use it on its own? A new phone in a phone case? Yep, you can use the case on its own, but what about building a house? Can the customer benefit from just the windows without the walls and the roof? Not really. The windows, bricks, and labor are all just inputs into one big performance obligation, delivering a finished house. All right, we've identified the contract and the promises. Now for the fun part, the money. We need to figure out the price, split that price up among our promises, and then finally book the revenue. Step 3 is figuring out the total price. Easy if it's a fixed number, but it gets complicated when you have variable consideration. Things like rebates, bonuses, or penalties. The standard gives you 2 ways to estimate it. If there are lots of possibilities, like a volume discount, you use the expected value method, which is kind of like a weighted average. But if it's a simple binary outcome, like a bonus for finishing on time, you just use the most likely amount. So in step 4, you take that total price you just figured out and you slice it up like a pizza.
Each performance obligation gets its own slice. And how big is each slice? Well, it's based on its standalone selling price, which is just a simple way of saying what you would charge for that item if you sold it all by itself. And finally, step 5. This brings us full circle, right back to our main idea, control. This is where you actually recognize the revenue. You do it when you satisfy your promise. Sometimes that happens over time, like for a monthly subscription service. And sometimes it happens at a point in time, like the moment you hand over a product to a customer. So that's the 5-step model in a nutshell. Now, to make it really stick, let's look at how this framework helps us sort out a few common scenarios that can be a little confusing. Okay, let's talk warranties. Is a warranty just a basic guarantee that the product works, or is it an extra service? Well, a standard out-of-the-box warranty isn't a separate promise. It's just part of delivering a quality product. But if a customer pays extra for a 3-year extended warranty, that is a separate service. It becomes its own performance obligation, and you have to allocate some of the price to it and recognize that revenue over the 3 years. This one is huge. Think about a big online store. When you buy a product that's sold and shipped by them, they are the principal. They control the inventory before it gets to you, so they record the full sale price as their revenue. But what if you buy from a third-party seller on their platform? In that case, the online store is just an agent, connecting a buyer and a seller. They only get to record their fee or commission as revenue. Again, it all comes down to who has control. And finally, how does this all look on the balance sheet? Well, it depends on who's ahead in the deal. If you've done work but can't invoice for it yet, you have a contract asset. Think of it as, I've delivered, now I'm waiting for the right to bill. On the flip side, if a customer pays you up front for something you haven't delivered yet, that's a contract liability. That's you saying, I've been paid, now I owe the customer something. Whew. Okay, we've covered a lot of ground. After all those steps and examples, let's zoom back out and focus on the one big idea that holds this entire thing together. It really is this simple. It all comes back to the transfer of control. So if you're ever looking at a contract and feeling a little lost, just stop and ask yourself one question. At what point does my customer gain the ability to use and get the benefits of this good or service? The answer to that question will almost always point you in the right direction. And that question, when did control really transfer, is the absolute key to understanding revenue under IFRS 15. Asking it will completely change how you look at a company's performance because you'll be looking past just the numbers and seeing the true story of when value was actually delivered.